Welcome to you all. Thank you very much for joining us here at Bloomberg for this event. And so this question that we started with the audience, Tina, I thought this maybe plays to some of your strengths initially, and we'll widen the conversation out around the panel as well. But let's talk about this then. So given the political risks, Tina, are markets too complacent? Maybe set out your biggest risk for markets.
Well, you never go wrong by criticizing investors for being too complacent about political risks, but given the environment of the last several years where political risks haven't had much impact on markets, with a very sort of narrow window of experience, it's not surprising, I suppose, that investors have become complacent. With a longer-term historical perspective, and considering that what we really see is a striking disconnect between the performance of the global economy, financial markets performance, and pretty dire politics and in advanced economies, which can be systemically significant. For me, it's the disconnect that is notable and is actually an alarm signal. If we extrapolate that forward and think about how we are entering a period of tightening in central bank policy, more concerns about inflation, growth is probably going to be reasonably good for some time going forward. I think that political risks will start to register more than they have in the past. And then with a backward-looking explanation, if you've been trading in the markets for the last 8 years, you would be forgiven for thinking political risks don't matter. But you must remember that that has been underwritten by QE.
Yes.
QE has really served as a buffer that has masked political risks, and I've argued in my research possibly made things worse, because what hasn't happened is volatility coming from markets through the traditional channels of an oil price spike or a growth shock to put pressure on policymakers, and that might have made things worse.
Okay, and so with quantitative tightening taking place, perhaps those political risks are a little more to the fore, a little less disguised by the readily available easy cash. Let's revisit the poll then, and what the audience has said here, almost evenly split. I mean, there's not an enormous amount, is it? But a few more people saying that, yes, markets are too complacent on this. Richard, your thoughts then, as we sit here towards the end of 2018, hard to believe, we're almost there, into 2019, do you think we're all too complacent?
So I'll start by making a broad statement, which is that we see very little signs of investor complacency at all. So, and we see that when we look at flows, when we look at the valuations in markets. And purely speaking personally, I spend a lot of my time meeting clients, meeting investors, and those conversations are dominated by concerns and worries. And we spend all our time talking about what could go wrong. So this is very different from periods of complacency which have preceded major market corrections, if you think of the late 90s or 2007. So in aggregate, we see very little evidence of complacency. And in fact, if I look at where the flows have been going this year, actually, the area in the industry which has seen by far the greatest flow has been short duration bonds. So again, not consistent with any sort of sense of complacency or euphoria in the market. But I will agree with Tina's comments, which is I think that political risks have risen, specifically around trade risk with the US and China. At BlackRock, we try and measure political risk. So we get data and try and capture what the markets are focusing on. And actually, it's quite interesting right now, because what it shows is perhaps what's obvious, which is US-China trade risk is high, and it's very much top of mind. There's a lot of risk priced into markets, but actually broader geopolitical risks are actually low. So perceptions of broader geopolitical risks are low. And I think that does create risk. It creates risks that those rise. But the risks are around at what point do those political risks start to impact the macro? Because the lessons, as you say, of the last few years has been as long as the economy is fine, as long as the economy is charging along and earnings are strong, then actually the market can weather these political risks. And you've seen that this year, where actually markets of valuations have fallen significantly since the beginning of the year, but markets are generally
It's almost as if the trigger has to be very big and absolutely imminent. Right, as someone said when North Korea was testing missiles, does it have to be halfway on its way to Los Angeles before markets take notice?
Wake up?
Yes.
Well, let's just. This raises an interesting question about whether political risk can be contained. If we do start to see it unleashed. And just as an example of one of the sort of political risk stories we've spent a lot of time talking about at Bloomberg TV very recently, I've got a chart which I think should miraculously appear behind us. A BTP 10-year yields, spiking over Bunds, spiking over Spanish debt. We could have chosen, but I think this is the BTP Bund spread. Just as a reminder of how much political risk can maybe rise up and manifest itself, at least around this specific Italy example. Karen, your thoughts on political risk as we go into 2018 and whether we're complacent?
So I think it's definitely going to generate more volatility in a QT rather than a QE world. I think that's absolutely right. But I think there's a question of does it generate volatility and does it change the absolute direction? And although I think we have to be very nervous about it near term and the impact on markets, I think there have been numerous episodes over the last 10 years where, stretching from Greece to where we are with Brexit right now, where at the end of the day, the economics trumps the politics, and the economic realities of the political promises that are being made eventually means that you get to the right economic outcome. And I think we've consistently seen that if you focus too much on the near-term political headlines and political noise, and you sort of get lost in that swathe of pessimism, then 6 months later, you were on the wrong side of that trade. So I think it's definitely, we should never believe polls anymore, I think is lesson number one.
In this room.
Apart from this one. But, we have the midterms approaching. I have no interest in looking at the polls. I'm just going to wait till the next day. Be prepared for unusual outcomes of all of these political events, but then don't get lost in the fog of pessimism immediately afterwards, and remember that, at the end of the day, these politicians have to be responsible for the economic choices they're putting on the table, and reality tends to constrain them at the end of the day.
And I wonder, Tina, from a European perspective, how much change you can come back on Karen's point, but I just wonder how much you've reflected on the European Parliament elections next year, as we're just showing that chart of Italian government yields. How much you think the conversation might or might not change after we see those elections? Because it's not usually a focal point for investors, European parliamentary elections.
In fact, I think that we need a new vocabulary for talking about this. Karen just said sort of noise versus signal, and that's the way we're trained to think about things. And I want to introduce another category, which is things that are a political signal, which may start to form a trend line and become a market signal. Because I think that it's easy to be too dismissive. I also think we can put some more structure around things like looking at polls. I'm a political scientist, and of course that's what my role is. So I think that we can do a better job analytically of anticipating outcomes. And one of the things I advise my investor clients is to switch the thinking from dividing political risks into tail risks, which low probability, high impact events, and the base case, to looking at plausible risks. And the number and range of plausible risks in a political risk environment is going up. And I think the midterms is a perfect example. Midterms are not usually a market signal even for US markets. I'm arguing that they are an important signal not just for global investors, but for leaders. So we talk about US-China trade tensions, the Iran deal, which could see and will see supplies constrained coming out of Iran and is already having an impact on oil prices. Those leaders are going to look at US midterms, which are a referendum on Trumpism, in effect, and be trying to determine how much political capital to invest in making a deal with this president when they're not sure if he's going to be in office one more year because of impeachment, removal, resignation risks, 2 more years because he ends up being a one-term president, or 6. So I think we need a more nuanced take.
And Karen, you said that a lot depends on the underlying economy. So let's talk a little bit more about the underlying economics here and some of the market moves we've seen in connection with that. I've got another poll question. Just warning as I preamble my way into it. I want to talk a little bit more about fixed income because we've got a polling question, the next one on the list. What will be the peak in 10-year Treasury yields for this cycle? As we sit here towards the end of 2018, moving into 2019, this seems like a good time to revisit end-of-year targets and think about where Treasury yields go next year, as this has been such a talking point. Are we at an inflection point? Have we seen one just in the last couple of weeks? So the options on the table, as you can see, 3.25 to 3.5%, 3.5 to 4. 4 to 4.5 or above 4.5%. So Richard, maybe we'll come to you first, and we'll leave that up, and we can all ruminate on what it tells us. So I think the most votes coming in for 3.5 to 4 by the end of this. By the end of this cycle, sorry, the important caveat. What will be the peak of 10-year Treasury yields by this for this cycle? Richard, your thoughts? Would you go with the room?
We'd be slightly above the room. So our view is fair value for 10-year treasuries is somewhere in the region of 4%, but it's likely to take many years to get there. So I think it's an important aspect to this question, which is for this cycle and when does this cycle end? So we put fair value around 4%, and actually what gets us from where we are today, around 3.2 up to 4, is actually not about a rise in inflation expectations in our view. Actually, inflation expectations have largely adjusted upwards already. It's actually about a rise in the term premium, about a rise in the compensation for risk that you're paid for taking longer duration assets. And that's really been the story for much of this year. So we look at the rise of yields this year. It's really been a story about not rising growth expectations. Growth expectations have actually been coming down slightly. Not rising inflation expectations have been remarkably stable. It's actually been rising term premium or rising risk premium. The term premium today is extraordinarily low. And it's extraordinarily low partly because of the impact of QE for many years has had on the system, and partly because we've had this sort of compression of yields out on the curve where many investors have been forced to go out and buy longer duration, high risk assets over time. And our view is that's gradually going to unwind. But the word gradual is important there because there are still a huge number of investors around the world who need income, who need yield. We see flows every day coming into income assets. So, you look at insurance companies, pension funds, particularly here in the UK, where regulatory change forces investors to buy longer duration assets, which suggests that the move higher in yields is likely to be gradual, and that whilst we see 4 as a reasonable level for fair value in 5 years' time, our view is actually it's likely to take many years to get there, and actually the equity market can withstand a gradual rise in yields.
Okay, and it's the pace at which we get there, isn't it, that's important then, I suppose. So Richard's saying at 4. Karen, your thoughts? Jamie Dimon's been talking about 5% or more, hasn't he? But
he's my boss, so obviously, absolutely, agree with him entirely.
But HSBC have got a forecast, I think, 2.5% next year. Maybe that was a rise actually up to 2.8, but lower than 3 at least. What are your thoughts on the end of the cycle peak?
So I think it's worth decomposing the question into what are the factors within the US itself that's going to drive that yield higher, and I think there are US factors that will drive that higher. I agree with what Richard said about the term premium. I think what needs to still shift, which will take that term premium higher, is not just the process of quantitative tightening, but just as people's expectations about the distribution of inflation normalize, because I think expectations are still very heavily weighted by deflation being a much higher risk than inflation. And I think that as that normalizes, that's going to push that term premium higher. I also think we're going to see some recovery in productivity that we're starting to see come through in the States, and that ease that secular stagnation story, and that maybe drive the real rate up as well. But I think to see 4 numbers, and certainly Jamie's 5 number, I think we do need to also see the process of normalization elsewhere in the world. I think we can't forget that it's a global market, a global search for yield, and 0 interest rates in Japan and negative interest rates in Europe, I think are still underpinning or weighing, if you like, on that US 10-year.
Talking very nicely to the chart on the screen there, which shows, the Fed ahead of other central banks. Tina, the Trump administration and its plans for fiscal spending and therefore issuance, clearly something also to consider when thinking about where rates go. What do you assume around that theme?
I forgot to answer your point on the European parliamentary elections.
Oh,
That's
please,
what I'd like to say first.
Please go ahead.
Because I sort of set it up, but then didn't go on to answer it. The European parliamentary elections are another example of something that never moves markets, won't move markets, I would argue, but will be of interest to investors on that notion of a political signal. So those are, I think, May 2019, and you see the fringe parties, non-mainstream parties, not only populist, but mainly putting everything they have into increasing their political market share. Their photo yesterday on the cover of the FT with Matteo Salvini and Marine Le Pen. These parties are going to do well in those elections because their voters are mobilized to turn out. And what they do is use them as a platform to test their policies and ideally in general elections to do better. I think Steve Bannon will be speaking to this later this afternoon, but I think it's important to appreciate that the economic performance hasn't really interrupted the popularity of these challenger parties. We posited that several years ago in our Vox Populi thesis. But what I think is true is that a crisis will accelerate their popularity. So first of all, we haven't got a huge number of systemically significant elections next year, but that will be something to watch. On rates in the U.S., I don't have any assumptions. I don't do that in my role, but I think investors would have noticed President Trump's comments suggesting the Fed is moving too fast.
Doesn't like it.
Yes, they don't have to do that, I think he said. Concerns about the independence of institutions is going to be one of my big themes for 2019, because after these non-mainstream political leaders took office, investors comforted themselves with the idea that, particularly in the US, the system of checks and balances, and elsewhere in the world, robust, decentralized institutions would kind of insulate from downside risks. I think we have to let go of that comfort blanket.
Okay, let's get to one more polling question as the clock ticks down in front of me. The third and final polling question of this session, and this is to do with the US equity markets. When will the US equity bull market end? And you can answer this by saying 2019, 2020, 2021, or later. We didn't actually put in the option of this year. Maybe we should have done that. It was a little presumptive. And we also didn't put in the option of never. If anybody wanted to vote with that one. But this is what we see. Oh, this is interesting. 2019, the Wile E. Coyote moment, I think Ben Bernanke referred to, maybe coming sooner than you think, according to the room. Karen, your thoughts on when the US equity bull market comes to an end? And we've got a chart, I think, that shows, we'll keep coming back to this polling. We've got a chart that shows US stock outperformance versus Europe versus emerging markets, of course, because that's been a big theme of 2018.
Okay, well, let me talk you through the steps which end the economic cycle and therefore the equity market cycle. So I think what will happen this time, what causes the peak this time, is a more traditional recession. So the Fed incrementally moving away from the accelerator towards the brake, and those higher interest rates start to eat into profitability. At the same time, wage costs are going up, and we see that earnings squeeze, and then companies starting to shed labor, and that sort of taking us into a recession. So then I take a step back and say, okay, well, the Fed are really, I think, driving that. And so I have to then say, well, at what speed are we going to get to that tipping point from accelerator to brake? And I think I'm not too worried about inflation gradually accelerating. I think we are still going to see on a gradual upward trend, and I'm watching oil prices, so I'm a little more nervous than I was about that inflation being added to the system alongside the tariffs. But I think we'll continue to see it just on a gradual upward trend, unless we get tax cuts 2.0 past the midterms, which could happen. Then I think, naturally you're getting some of the heat come out of the economy in the second half of next year anyway, as the fiscal tailwinds end. So I don't think the Fed are forcing us next year to that point of downturn. So I think I would be slightly more in the 2020 than 2019 camp.
Let's put the polling results back up and see where they've settled. But 2019, there we go, still the most popular answer. Richard, your thoughts?
Well, first of all, I think this helps answer the first question about how much complacency there is in the market, with almost half of the investors thinking the bull market ends in the next year. So when we look forward, what we can say with confidence is today we don't see any evidence that the bull market is about to end. And so we think about, so all our economic signals suggest above trend growth in the US and indeed globally over the next 12 months, and actually suggests, as a base case, actually some scope for consensus to rise. So when we think about what could cause the bull market to end, then we'd agree. I think there's three causes we'd focus on. So one is sort of traditional overheating, as Karen highlighted, which is inflation accelerates, the economy is too strong, the Fed stamps on the brakes, and you have a traditional inversion of the yield curve. We see very little evidence of that today. The economy is strong, but we don't see any signs of overheating. Inflation has actually been surprisingly stable. That could change. The second, which we talked about earlier, is geopolitical risk, that we have an escalation of trade war between US and China. But importantly, that cracks corporate confidence and the economic cycle. So and again, we've seen an escalation of trade risks, but as yet, no evidence of that materially dampening economic growth, and even less evidence, less than none, of it dampening earnings growth, because earnings growth in the US is extraordinarily strong and extraordinarily broad-based. All major sectors delivering above-trend earnings growth, above-trend revenue growth. This is not a stock market been driven by a small group of stocks.
And that's not too backward-looking for you.
Sectors. Now, the forward-looking signals are extremely positive. We're seeing the breadth of earnings growth, the breadth of revenue growth, and our forward-looking signals suggest actually double-digit growth in earnings over the next 12 months or so. So I think about the third risk, which is that it's a financial risk. It's not a recession. The global financial crisis wasn't caused by a recession. The global financial crisis caused the recession. So what evidence do we see of a bubble, of excesses within financial markets today, which themselves could burst?
Something like the IMF is just warning about right now.
Well, we see very little evidence. And actually, this year has been a good test. We've seen actually a whole series of volatility spikes through the course of this year, starting with Bitcoin at the beginning of the year, and followed by the VIX spike, followed by the tech volatility and various emerging market volatility showed the Italian spreads there. But yet, remarkably, the market rolls on. So we don't see the evidence today. When we look at overall financial conditions, we don't see the evidence of a bubble. So when we look at those three things, what we say today is with some confidence is we don't see the conditions for the end of the bull market today. And that if you believe earnings are going to remain strong, then you should be pro-risk. But what is true is that uncertainty is increasing, because uncertainty about where we are in the cycle, about inflation, is increasing as the economy continues to expand. And uncertainty about political risk is increasing as well. And what that suggests to us is you want to be pro-risk, you want to have equities in your portfolio, be overweight, but you want to focus on those areas which are most resilient, those areas with the greatest confidence. To us, that is many areas within the US equity market. But you don't want to be too far down the risk spectrum because of some of these concerns.
Tina, does your political eye lend you in any direction or other with regards to when the bull market comes to an end?
Well, the way that I approach that is to think about any kind of near-term signposts which might spike political risks in a way that will get the attention of markets. So with that in mind, I suppose I am what passes for being fairly optimistic in the short to medium term, just because we don't have very many important signposts in that regard. I do think that the role of political risks in this kind of market environment can be to compound more traditional risks where they occur. So Italian risks is a great example. If we end up having a snap election early next year, I think that will focus minds. You will see a larger share go to Lega Nord, with increasing their capacity to do more. On the U.S. front, I think that anybody who looks at U.S. midterms with kind of the old eyes and thinks that, for example, a divided, rather a Democratic-controlled Congress just means division between the White House and Congress is missing a trick. I know that investors I talk to are worried that if there is a blue wave and Democrats end up controlling both chambers, a tough road, but not impossible, they might roll back the tax cuts. I don't think they'll do that, but I think the markets think that they might do that. And there will certainly be more pressure on the president and more investigations and tensions on that front. On geopolitics, I think it's probably risk off on North Korea for now, just because it's incredibly bad form if you're in the midst of diplomatic negotiations to attack somebody. So, that's not a permanent resolution, but it puts it to one side for now. If I were to flag one risk, though, that could kind of rear its head, it's Iran, where the remarks at the UN General Assembly were very hostile indeed, and I think that we shouldn't rule out the possibility of certainly much more inflammatory rhetoric toward Iran and a talk that sounds like war talk.
Okay, and I just came from the TV studios this morning where we spent a lot of time talking about the oil price with that in mind. Thank you very much for getting us started this morning. Thank you very much for joining us here at Bloomberg, and thank you to the audience for participating.